For nearly a century, this bank from Kerala has quietly served millions of customers across India. But in the last decade, it went through one of the most difficult phases in its history: rising bad loans, weak profitability, and falling investor confidence. Now, the management says the turnaround is underway. But do the numbers really support this story? Hello, everyone. I am Sebi George, and this is Decoding Equity, where the companies are analyzed through numbers and not by noise. Today, we are decoding the business and the financials of the South Indian Bank. One encouraging aspect about the South Indian Bank is the visible improvement in asset quality. The bank has been steadily reducing bad loans while strengthening its capital position. At the same time, the management has shifted focus towards retail lending segments such as gold loans, housing loans, and personal loans, which generally carry low risk compared to the large corporate exposures. This gradual shift is helping the bank stabilize the profitability and rebuild the investor confidence. Quarterly revenue increased from 1,898 crores in December 2022 to 2,518 crore in December 2025. The trend shows steady expansion in business volume, with revenue crossing 2,300 crore during 2024 and maintaining an upward trajectory thereafter. Quarterly net profit increased from rupees 103 crore in December 2022 to 374 crore in December 2025. Despite some quarterly fluctuations, the overall trajectory shows a steady improvement in profitability over the last 3 years. Asset quality has also improved significantly. Gross NPA declined from 5.48% in December 22 to 2.63 by December 25, while the net profit reduced from 2.26% to 0.45%, indicating a strong cleanup of the loan book. If this style of analytical breakdown adds value to you, consider subscribing. I publish structured company research regularly for the serious investors. Institutional participation has also increased significantly. FII holding rose from 14.6% in March 23 to 20.9% by December 25, while the DII holding increased from 7.6% to 13.8%, indicating growing institutional confidence in the bank's turnaround. Capital adequacy ratio measures the financial strength of a bank. It compares the bank's capital with its risk-weighted assets, mainly loans. South Indian Bank's capital adequacy ratio stands at 16.04%, comfortably above the effective regulatory requirement of about 11.5% under the Basel III norms. Return on equity measures how efficiently a bank generates profit from shareholders' capital. South Indian Bank's ROE has improved sharply in the recent years. It was 1.1% in financial 21 and improved to 13.8% by financial 25, indicating a clear turnaround in shareholder returns. When compared with other private sector banks, South Indian Bank's valuation appears significantly lower. Large private banks such as HDFC, ICICI Bank, and Axis Bank typically trade between 14 and 18 times. In contrast, South Indian Bank trades at a PE of around 7 times only. Interestingly, the bank's return on equity is 13.8%, as we said earlier, comparable with several mid-sized private banks. South Indian Bank has declared a dividend of 0.3 per share for financial 25, marking a continuation of dividend payments after several challenging years. With improving profitability, lower NPAs, and a comfortable capital adequacy ratio, the bank now has a stronger foundation for gradual growth. However, sustaining this turnaround will depend on the bank's ability to consistently improve profitability while competing with the larger private sector banks. Despite the recent improvement, some risks still remain. South Indian Bank operates in a highly competitive banking sector dominated by large private banks and public sector banks with stronger balance sheets and a wider distribution network. Any deterioration in asset quality or slowdown in credit growth could again impact profitability. Therefore, the long-term success of the turnaround will depend on consistent execution and disciplined risk management by the bank's management. This video intended purely for education and analytical purpose. The analysis is based on publicly available information and I do not provide any investment advice. It should not be considered as a recommendation to buy or sell any stock. Investors should always do their own research or consult a financial advisor before making any investment decision. Improving asset quality, rising profitability, and increasing institutional participation suggest that the recovery process is underway. However, investors need to watch whether this improvement can be sustained consistently over the coming years. Thank you for watching Decoding Equity. I am Sebi George, and I will see you in the next analysis.